Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, and I am on the line here with a very special guest, and that guest is Herb Morgan of Efficient Market Advisors. Herb, how you doing today?
Well, I'm doing great. Good morning. It's a little early here on the West Coast, but we're happy to be up and at it.
Oh yeah, where you calling from? California?
San Diego.
San Diego. Yep, you get your day started early and ended early too. So, to get started, I like to ask people about their education and their market background and kind of how they ended up doing what they're doing today.
Well, sure. I'm sitting at my desk, and I'm looking at about a 3.5-inch yellow blob called a banana slug. I am a proud graduate of the University of California at Santa Cruz, #1 economics department on the West Coast.
All right, the banana slugs. I like that. I do know about the banana slugs.
Yeah, we're real proud of our business economics program there. A lot of great and successful graduates over the last 50 years. Just celebrated 50, or we will celebrate 50 years in 2015. And I kind of rolled into this business after I decided I couldn't afford the PhD program I was enrolled in at the University of Washington, Washington University in St. Louis. And got into the securities industry, spent a lot of time in the mutual fund business with Dreyfus, J.W. Seligman, and Pilgrim Funds, which we sold out to ING. Then I ended up launching Efficient Market Advisors. We were the first ETF strategists. We launched this business back in 2004.
Okay, so tell us about that, Efficient Market Advisors.
Well, we are an intermediary-driven investment management firm, which means the way that the public gets to us is through professional financial advisors around the country. Back in the early 2000s, I was working with LPL. I was senior vice president of advisory there. And we noticed the popularity of tactical mutual fund programs or mutual fund wrap programs. And we thought, wow, there's a great opportunity here to launch and be early and have one of the longest track records when we finally did hit that 10-year mark. Because ETFs were just coming to the market in bulk. I mean, there had been in the Qs and the spiders had been around a while, but fixed income ETFs hit in '02. REIT ETFs hit around the same time. That there's just a great opportunity here to build complete institutional style portfolios using exclusively exchange traded funds, lower the cost to the consumer, and really bring about what the separate account industry tried to do, starting with E.F. Hutton and the consulting group back in the late 1970s.
Okay, and do you expect this trend to continue?
I do. ETF managed accounts, or what Morningstar has now dubbed ETF strategists, is about a $110 billion segment of the separately managed account industry. And it is the fastest growing. The CAGR, the consolidated annual growth rate of what we do is running north of 40% annually. And even at that, just over $100 billion mark, it's still pretty small. So it's a really exciting space. There's a lot of parts of privately managed accounts that just didn't ever quite work for individual investors, and we think this brings it all together. And big brokerage firms are starting to take notice and giving these kind of separate account managers access to their distribution teams, and we think we've got a long way to go in this trend.
Could you talk about, what some of the advantages are and disadvantages, if there are any?
Well, sure. I think that, if you think about the average household, the average investor household with separate account assets, they tend to have about $750,000 to $1 million. And when you think about that, if you're trying to get a broadly diversified portfolio, you need to start with an asset allocation model. And if your asset allocation model says, I think I need to have 15% in emerging markets, and if 15% is in emerging markets, how do you pick a fund or a manager when it's only $100,000 or $150,000? It's very difficult to get that right, because we believe that asset allocation is one of the primary determinants of return. We think the best way to get your asset class exposure is through very low cost, very tax efficient exchange traded funds. That way you can really measure your ability or your manager's ability as a money manager, as an asset allocator. So what's happening now is the research shops are starting to refer to us as beta managers. And it's
Okay.
a big growing trend in the industry. Managing beta, figuring out where to put the assets, and then being measured by that is really taking off right now.
And any disadvantages?
You know, the disadvantages is you give up some of the sexiness of picking individual names. I mean, I grew up in this industry with, in an era before the index-based vehicles and certainly before the ETFs took off. And there is some fun and excitement about doing individual company analysis. Although it saves me a lot of money on research analysts and a lot of
Yeah.
grief when you get things wrong, I'd say that's probably the biggest disadvantage. I also think too for smaller investors, when I say smaller, I mean anybody under $10 million portfolio. That's kind of where most individuals sit. I really don't see the disadvantages to it. These ETFs really are mutual funds 2.0. They're faster, they're better, they're cheaper, and they're more tax efficient than almost every other strategy out there.
And their betas, keep up with the market, both, on the upside and the downside as well.
They really do. Because the ETF industry itself has grown, and we're approaching 2 trillion here in the U.S. and about another 2 trillion outside of the U.S. There are some fringe players, and investors do need to be careful. But 75% of the assets going into ETFs are going into traditional cap-weighted indices, whether fixed income or equity. The costs are low and getting lower. That being said, because the industry is growing so rapidly, there are a lot of cute gimmicks out there, and I think investors need to be careful and not be lured into some of the kind of wacky, weird stuff. Check the expense ratio of the ETFs you're investing in. Check the underlying liquidity of what they invest in, because sometimes when you try to create liquidity where none normally exists, you have the potential to run into problems. Also, a lot of manufacturers are getting cute and clever with the indices that they create. There's a lot of indices that just don't make sense.
All right, so no individual issues for you. It's all ETFs.
That's right. That's the thing that makes us unique, and it's made Efficient Market Advisors a unique money manager since we launched in 2004. We don't buy any single stock, and that's great. We don't have any single stock risk. One or two names can ruin your track record for a year. We want to be measured, we want to be hired, and we want to be fired on our asset allocation ability. Therefore, it's our focus once we decide on an asset class, whether it's buying Russia or buying the tech sector. We want to be measured on that decision. So therefore, we're constantly seeking the lowest cost access to each asset class.
And how do you decide what ETFs to buy? I gotta imagine that you probably dig deep into fundamental analysis. Is that your go-to approach?
It really is. I mean, first of all, we take a very institutional look at building the portfolios. So first of all, we're going to start with a strategic asset allocation model. And while that's pretty much boring, we even call it monkey math here at our firm. We do it on a very regular basis. And strategic does not consider what's happening in the world today. We don't consider, that Japan may delay their value-added tax in strategic analysis. And that's also the reason that strategic asset allocation falls short. So we start with that. Then we move in. We have a 5-person investment committee, and after the strategic asset allocation decision, then within the confines of our investment policy, we make tactical decisions to overweight, underweight, or eliminate sectors, industries, countries, regions, and then the same kind of analysis, tactical analysis within fixed income and within the alternative space. So we have strategic ranges for equity, fixed income, and alternatives, a very broad, balanced portfolio. Then deep fundamental macroeconomic analysis, looking at all the data that comes out on a daily basis, like industrial production today and empire manufacturing today. And then we make those decisions, and then we just implement all those decisions using ETFs. Another one of the great tools that we have is we have the ability to be opportunistic in our asset allocation. Back in the crisis of 2008, we had a lot of great opportunities to rebalance off schedule. We had opportunities to pick up preferred stocks very cheap when Chris Dodd said on TV that he was considering nationalizing the U.S. banking system. So a lot of wacky and weird stuff that happens every year in financial markets. We try to take advantage of that when the opportunity presents.
What about the charts? Herb, do you pay any attention to technical analysis?
Yeah, we really do. We have a 5-person investment committee, and we have 2 people that are probably more technically savvy than I. I think, though, that we look when we look at charts, we look at them from a very high level. I've been been in this business a very long time, and there's always a hot dot manager that says when this line crosses that line, it's time to buy, and when that line crosses below the other line, it's time to sell. And that sometimes they can go on pretty good runs for a couple of years, but my experience is that they invariably blow up. The highly technical, the pure technical in or out of the market, levered in, levered out managers tend to be fleeting. And we tend to be longer-term investors, but we may use technical analysis to confirm what our fundamental bottoms-up analysis is telling us.
And any hedging strategies? We had some turbulent times in the markets there back in mid-October. Did you participate with like the SDS or any of the triple-weighted bear ETFs? Use those as a hedge, or do you just prefer to try to go on the sidelines if you see turbulent times ahead?
You know, the greatest alternative investment, the greatest hedging strategy of all time is called the United States T-bill. A lot of what Wall Street creates in terms of having hedging strategies is just so skewed towards the profitability of the manufacturer of the products that whenever we consider something as a hedge, we have to compare it to what would happen if we just went to cash, T-bills, or tips. Usually, it's better to just increase your cash weighting. That being said, there are great ways to hedge international equity positions through some good ETFs that use futures to take out the rising dollar. For example, for the last 8 months, we've been slowly accumulating a position in European equities here, and I expect that we're going to continue to do that. We're starting to see signs that we're right, and you never want to go where things are great. You want to go where they're going to get better, and we really believe that's the case with Europe. We saw last week with Cisco's earnings, the big surprise for Cisco's earnings was actually European strength. We still think the ECP is going to do well, and so we have a position in the Deutsche Bank Trackers European Hedged Equity ETF. Takes out the risk of the rising dollar, but gives us exposure. We would rather do that than buy a double or a triple or an inverse or use options or futures. Those are pretty high-risk moves, and we tend to be a more conservative manager.
Okay, could you give us any other ETFs or sectors you kind of have on like the undervalued or, on your watch list?
Yeah, sure. I mean, we're looking at a lot of things all the time. Right now, and we don't own it, and I don't know that we will, but we have been looking very closely at Russia. And, Russia is very, very cheap, single-digit earnings multiple, less than book value, reasonably high dividend yield, and for very good reason. U.S. economic sanctions and falling energy prices in a basically a psychotic despot as president. So therefore, therein lies the opportunity. Where the entry point is, that's where we might look towards technical analysis. But we're looking at Russia, a much lower risk potential opportunity would be here in the U.S. The whole technology sector seems to be doing very well, is yet to get fully valued in this economic recovery. Probably just a little bit nicer play. Another area that hasn't yet fully recovered in the U.S., instead of an industry looking deep into a sector, an industry rather than a sector, would be home builders.
Okay, what's your take on home builders?
Well, if you think about it, the residential construction has somewhat recovered in the U.S., but we're certainly nowhere near the number of new homes we were building, even before the bubble of 05, 06. We have about 320 million people living in the United States. Population grows by about 3 million a year. If our population grows at 3 million a year, we need to build about 1 million new homes. We're only building about 500,000, actually less than 500,000. So it's just a matter of time before the manufacturers of new homes step up production. We've mostly worked off the inventory related to the excess housing that we built in '05 and '06, and we think it's just a matter of time before that starts to come around.
We got a question out of the chat. I think I know the answer. I mean, looking at the Russian market, you're just looking at the ETF, right? There's no individual issues that you would try and go into. You would just play the sector, the sector ETF as a whole.
That's correct. I mean, the way we do things here is because we're macroeconomic oriented, we wouldn't go in and try to figure out, is it Gazprom or is it something else? We'd look at the only at the ETF.
Okay, any overvalued ETFs that you think that, maybe you have a nice position in, you're thinking of taking profits or something that you want to get into, but boy, it's just way overvalued.
In the world of fixed income in general and longer maturity fixed income in particular, I mean, if you look at something like the TLT, which is a 20-year Treasury indexed, ETF, which is up, 18, 19, 20% for the year. I think the risk in the fixed income is to the downside. We see almost no risk premium in fixed income looking out 5, 10, 15 years. So I think if you're long and if you look at your ETFs and you look at your duration and your maturity, and it's in excess of that of the ag, it's probably time to consider going elsewhere, shortening up those maturities, and then extending later when interest rates finally rise. Of course, to be fair, we've been in that position for about a year, and we haven't seen that pickup in interest rates yet. Regardless, the whole risk-reward dynamic of fixed income is disfavorable. Within the equity world, in terms of very fully valued, we see publicly traded REITs. On the one hand, interest rates are low, the dividends are good, they have clauses and leases that correspond with CPI. So there's some good things happening, but valuations on publicly traded REITs seem very, very high to us, and we'd look to enter somewhere else down the road.
Okay, and just any final tips for investors? Let's say they have a pretty concentrated stock portfolio. What would you say to them to kind of convince them maybe to diversify a little bit, look a little bit more at the ETF sector?
Well, look, I think if you have a concentrated stock portfolio and you've had it for 4 or 5 years and you have a very low cost basis in your names, I'd have a hard time telling you to get out of if they're good, large, dividend-paying companies, because the fact of the matter is taxes in this country and states like California, where I live, are prohibitive of such things. I think you need to watch the downside, and if you're building your own portfolio out, I mean, you start with good, solid dividend blue chip payers and stay the course, collect the dividends, and look for opportunities when they present themselves.
Okay, Herb Morgan, CEO and Chief Investment Officer of Efficient Market Advisors, giving us his take on the markets and why perhaps you may want to consider this sector for your investments. Herb, great interview, great responses. I hope we can have you on again.
Anytime. It was my pleasure. Thank you for the opportunity to be with you.